Good evening, everybody. My name is Jacob. I work as a senior strategist for a IP law firm called Lexorbis. I think my colleagues had taken classes prior to this session. So I've got just briefly about myself. 2 decades of experience. I founded a IP consulting firm in the past that got acquired by Lexorbis. That was in 2017, and since then I've been like a senior consultant for them. I also was on the board for a biotech company, which again got acquired last year by a European MNC, and that's been. I predominantly work in the field of patents. That's been my forte, and I do a bit of business and where I see a lot of IP transactions, and that's briefly about my background. Um, I think let's get started. I think we have 4 participants, so I
Yes.
think that's a good number to get
Yes.
started, right? Yeah.
Good evening, sir.
Good evening. Good evening, Deep. This is Nagarajun. Yeah. All right. So let me just share this presentation and then we will get started. Good. My screen is visible, right? Yeah.
Yes, it is.
So what we have today for the next 1 hour and 30 minutes, what we are planning to do is briefly discuss about IP valuation. I'm sure you would have covered a lot of aspects of IP. You are now well aware, and probably you would have already be in the field of IP, so you would be knowing something about it. So you would have touched about patents, trademarks, copyrights, then probably some other related rights. You might have touched upon trade secrets to an extent, probably designs, and then you have the other IP, which is more of community based. You have traditional knowledge, you have geographical indications, and so on and so forth. Um, but my focus is largely to do with IP when it comes to transactions. And then when we talk about IP, when it comes to transactions from a corporate perspective or from a startup or from an organization perspective, we actually consider largely patents, to an extent trademarks, and then bit of copyright. So largely patents, trademarks, and copyrights is what we build as assets in an organization. So that coming to that, till now you have been learning bit of IP when it comes from a legal perspective, from a management perspective. We are going to look into the commerce side of IP. Okay. So when I say commerce, commerce is nothing but you buy and sell items. So IP is an asset, right? Intellectual property right. We call it as an intangible asset. Uh, so there are two kinds of assets. You have tangible and intangible. And tangible assets, when we talk about tangible assets, it could be your computer, it could be any machinery, it could be your land or an apartment that you own. So these are all tangible assets, which means there is some sort of tangible tangibility to it, which means you can feel it. When it comes to intellectual property, it is an intangible asset. You can't, the feel it. It's a creation of the human mind, and so it's an intangible. But nevertheless, it is also we consider intangible as an asset. Why? What are the typical characteristics of an asset? So when we say, if you look at tangible asset, any asset, when we say, okay, it is an asset means that it has got some value to it. Okay, that is why it is an asset. Now, other characteristics of an asset is that it can have a fair market value, right? If you look at an apartment that you own or a land that you have, uh, there is a fair market value. So it can be classified as something which has got a fair market value. There is also the fact that it can have some appreciation or a depreciation when it comes to, let's take the example of a apartment or a land. Over the period of time the value increases, right? Versus if you take the example of a laptop, over the period of time there is a depreciation of the value of the asset. Okay. That's the other characteristics. The third is that you can transact. When you say transact the asset, that means you can buy or sell. the asset. Okay, so these are the sort of characteristics of a asset in general, and this applies largely to the tangible assets, and this also apply to intangible assets. Okay, and that's why we say IP is an intangible asset, because it becomes, there is some value that is associated with the intellectual property. Okay, and what are the circumstances under which you can do this transaction? Okay, where the IP or the patent can be transacted. And please note, in my slides, it will be mostly patents because I transact patents largely, but this can apply to from a other IP perspective when it comes to, I mean, typically the trademark and copyrights also. So if you look at the first and foremost for a patent to transact, what is the need? Let's assume that there is this organization which has got a patent. So the first and foremost thing that the organization tries to do is to exploit that patent. Okay, you can exploit it, which means you can put into practice, or you can reduce it to practice. You can offer this patent as a part of a product or a solution. Okay, when you offer this as a part of a product or a solution, it becomes an asset and there is a value to it, right? And then you will need to see, what is the value of this asset. Okay, so that is one of the, largely that is where an IP gets valued. Okay, what is the value at which you need to sell this patented product or solution into the market? So you need a valuation of that. Okay, you should know the valuation. Another instance is when you do technology transfer. You would have already learned about technology transfers in the earlier session. So when you do a technology transfer, you are actually transferring some value. Okay, how much is the value? So there also you would need IP valuations. The third, the and that is sale and licensing. You can outright sell your IP, okay, or your patents. Okay, you can do an outright sale, or you can license it to a third party, and then for a royalty. So then, what is the royalty? How do you calculate the royalties? Okay, there also you need valuation. The fourth instance is the enforcement. So if you are enforcing your rights, okay, if there is an infringement, and if you're enforcing your rights, and then the probably there is a the award given to you for the damages, right? How much is that damages? How do you calculate damages? Okay, when it comes to an infringement, there also you need a valuation. The other point is with respect to collaterals. Okay, this is not largely found in India, but in the Western countries, the US and Europe, you can actually keep IP as a collateral for funding, or for as a loan. The banks, there are agencies which actually give you loans. There are so that is very prevalent in the Western countries. In India, there are few instances, one or two, probably barring one or two instances, there is not much of a IP financing. The classical example is the Kingfisher example, where the brand was actually sort of kept as a collateral. But otherwise, in India, we don't have much of IP financing, though the government and the various stakeholders, the industry bodies are working towards it. But at the moment, that is not there, and so there is no requirement per se here. The last is again mergers and acquisitions. So even in the M&A context, right, when you buy or sell companies, there is an IP, a lot of IP might be involved. It could be trademarks, it could be a portfolio of patents, and then you will need to value this IP. So, and just note that when you over the period of time, people have a lot of research has been done, and especially when it comes to mergers and acquisition. Uh, it has been found that if an organization owns a patent, okay, the value of that, the value during the time of valuation, for every patent, there is a significant increase in the valuation number. There is this researchers which they actually did research on. They analyzed about 33,000 mergers and acquisitions, and they found that with every patent that an organization owns, the valuation increased by $1 million to $2 million. So that's the sort of range that we are talking about when it comes to valuation. And how do you value it? So these are all the various contexts under which the IP needs to be valued, and to understand, what are we trying to transact here, or what are we trying to buy and sell here. Apart from this, let me just let me caution you. Organizations protect IP just to ward off the competition. So probably in those instances, you really don't need to value the IP, because you're not going to sell the IP. You're not going to do anything with the IP. It may be just sitting there so that, as an asset in the organization, but you will not be making use of it in any form. But in indirect way, you're actually saying to the competition, please don't encroach this boundary, because we have protected in these areas. Okay. So that there you actually don't need to really get a fair market value of the IP. But these are by and large, the other instances, these are instances where you actually need to value an IP. Okay. And now I will not take each subject. So each use case here, this is quite extensive. I will just take with respect to sales and licensing. Okay, in the context of patent sales and licensing, how do we actually do evaluation? So typical steps that we as licensing people, what we look at, the first is that we do a due diligence when it comes to a patent licensing or a sale. So what I will just explain to you what is there, what are the steps involved in proper due diligence or an audit. The second step that we take up is a technology evaluation. When we talk about this, is very specific to patents, because this doesn't apply to trademarks and copyrights. But otherwise, when it comes to patents, so you actually need to evaluate the technology. What is how strong your technology is? What is your market? And so those things we do. Then comes the step of patent valuation. And there we actually assign a value to the patent. So this is the value at which it can be transacted, or this is the royalty that you can get out of this transaction. So that is the patent valuation. And then we go for a licensing or a sale. So there are steps involved in that licensing and sale. So I'll briefly touch upon each of them. So now when it comes to audit or a due diligence, so these are typical steps. The first step that we look into is that you actually verify the ownership of the patent. Okay, if you are not the owner of the asset, okay, you cannot transact. Fundamental principle: if you're not the owner, you cannot transact. So most important thing is the ownership of the patent. We look at the field of the invention. What area is this? What technology area is this? Okay, is it computers? Is it chemical? Is it mechanical? We look at the invention. What is the field of the invention? We look at the status of this. Okay, what is the status in the of this particular asset? Is it active? Is it a published patent application, or is it a granted one, or what is the current status? We look for corresponding foreign filings. So this is very important to see what is the coverage of your IP. So at times when you get into transactions, people don't disclose upfront. So it is very important that you do your due diligence from your part, saying that what is the extent of this IP, which are the other jurisdictions which this IP has been protected. Okay, because then you need to do a due diligence in those jurisdictions also. What's the date of filing priority? What's the publication date? Then what's the life of the patent? So this is very important, because every asset, you would have learned by now that trademarks needs to be renewed within 10 years. The copyright, the lifespan of a copyright is life of the author plus 60 years, 50, 60 years. Similarly for patents, it's 20 years. All right. So even in patent, when you talk about patents, even if there is 20 years, all this 20 years may not have such a value. Okay, like you have appreciation and depreciation. Ideally we look at 5 to 10 years max. Though we say 20-year period, we look at 5 to 10 years. That is the maximum that we actually look at from a what's the useful life of a patent. Okay, because the reason is that technology becomes obsolete every now and then, and there are hardly any technologies which is like going to be remain. I mean, these days there is no technology that will remain for like next 20 years, sort of thing. So we sort of give a value between 5 to 10 years if there is enough life in that 20-year life period. We look at whether it is still in force, which means that has the owner, the applicant, filed the necessary maintenance fees, or has it been abandoned? We look for any oppositions in the due course, whether uh, is there a pre-grant or a post-grant opposition. We look at for that. We look for that. And mind you, oppositions are good. In one way, it's good, which means there is a competition who's looking at you. And in fact, the more then that means your there is a value to your IP. So if there are oppositions, we thought we sort of look at it from a positive sign. Okay, contractual obligations, right? So if there are any are there any other contractual obligations? Is this a clean title? Is there any lien to this? Have you kept as a collateral? Have you given this to somebody else, saying that you can use this sub licenses and things like that? So are there any other contractual obligations? Last and foremost, you look at whether it's again litigated or not. If it is litigated, again for us it's a positive sign, in the sense like there is competition, there is a value that is going to be coming out of this litigation. So all this is something what we do in the initial stages of due diligence. Then I said the next step is the technology evaluation. When it comes to technology evaluation, we understand what the technology behind this particular patent application is. We see what's the trend in the market. We look for something called the CAGR. CAGR stands for the compound annual growth rate. That shows what is the, at an average in the industry, what is the growth rate with respect to different subsectors. Let's say there is a chemical is one industry, under chemical it could be something else. There are multiple hundreds of different other bifurcations you can have. So what is the growth rate across the industry? Okay? That is something which we look into. We look at the patent to product mapping. Are these is there a product behind this patent? If there is a product behind this patent, does the claim actually can be mapped to that product? And that's when the value for us, the value increases. What is the strength of the patent? We look at we do a prior art search. Usually, we do a prior art search, and we look at the which are the citations. Do you have forward and backward citations? How many people have cited this? The more the number of citations, the forward citations that you have, that means you're that's the in thing in the market. You are doing something very niche, which is of great interest, and the whole industry is moving towards that direction. And then once you do the prior art search, you will find the list of the prior arts that can be your competitors, that could be your collaborators as well. You can join hands with them. And after that, in the technology evaluation, we look at the technology readiness level. Okay, the TRLs, actually, this is something which the NASA also uses. You have various levels. This is given here, and this is you can actually Google for this. At what stage is your technology in? Is it in an idea stage? You've just conceptualized, or have you done a prototype? And at what stage this particular patented product, if you are exploiting it, at what stage it is? If it is not, if there is no TRLs, then probably it is just a patent asset that needs to be licensed out. Okay, so we touched upon first the due diligence part, then we touched upon the technology evaluation part, and once we have done these two exercises, then we look into the valuation, which is the our the topic for the day.
Sorry to interrupt. Who measures TRL, sir? Technology TRL. Who measures it? I mean,
So if there is a, let's assume there is an organization, the inventor and the organization will tell this is at which the TRL is. Okay, we are at TRL number 3. First is the at what level the TRL is, that will be indicated. Then at what level the TRL is going to be achieved in 6 months down the line, 1 year down the line. So that indication also will be given as an input from the applicant or the inventor.
Okay, sir. Thank you.
Yeah. So coming back, this is the core topic, valuation. So now we have done all the due diligence, we have done the technology evaluation. Now we need to assign a value to the patent or an IP. So this valuation is applicable across all the IP, but I will specifically focus on patents. Okay. There are many methods for valuation, and there are something called classical methods. There are other methods also called quantitative and qualitative methods. We will restrict to the classical methods, and I will briefly touch upon each of this today. And these are fundamentally taken from your accounting standards. So if you were to go to a chartered accountant, even a chartered accountant will, when if they have to do a business valuation, they will use the same principles. So these are called the classical methods of valuation, and this is universal in nature. Okay. So what are the classical methods? You have three methods. So you have cost method, you have income method, you have market method. Okay. Um, let's go one by one. So what is a cost-based method? Okay. Again, in cost-based method, there are two different methods. There are multiple methods. One is a historical cost approach. This measures the actual cost in creating the IP. So assume that you are filing for a patent application in India. Then the cost, let's say it is around 50,000 rupees. So that's the cost that is going to be expensed out of you, right? Now, you would want, let's say you get a grant for that patent application, patent gets granted, you need to maintain it. So that becomes the cost for you. Now, how do you assume a value for this? Okay. So let's say you spend around 1 lakh rupees, okay, for your patent to procure the patent or to create the patent and get it granted and to maintain it for the first 2 years. Let's say you spend 1 lakh. Now, this 1 lakh is your, sort of break even for you, right? 1 lakh and 1 rupee is, let's say you sell it for 1 lakh and 50,000 rupees. So that 50,000 becomes your profit, right? So you assign the value of 1 lakh. That's the value. That is the value that you spent. Okay. And you need to add some margin to it, right? Let's say 50,000 you have adding to it, and 1 lakh 50,000 is your value to the patent. This is the most simple form of assigning a value to your IP. Okay. What is the cost that you have incurred? You add a percentage to it, and that's the value. Okay. Then you have replacement cost approach. So this measures estimated cost of replacing the patented in the event that you, let's say it is not there, you want to recreate as an equivalent asset. So how usually this is done, we do a little bit more of, we add some more cost to this. So, okay, one is the original R&D cost. Okay. You have created this IP. It is not just an piece of paper, but you actually created some product and process out of it. Okay. So what is the cost incurred? So here we take the R&D cost. In R&D cost, what we do is we actually take the labor cost. Let's say you hired two engineers to create this. Okay, you have to pay salaries for them, right? So that becomes a cost, right? That's the labor cost. Okay. Then you also would have actually sourced some materials. Okay, you would have sourced some, you procured some, equipment. So these are all coming as the cost. Okay. Now to this cost, you actually add your opportunity cost. Now what we are trying to say here is that in absentia, let's say if you are not patenting something, okay, uh, you would have done something else. Okay. Meaning, let's say you have 1 lakh rupees with you. Okay. And this 1 lakh rupees, you decide, okay, I have this brilliant patent idea for patenting, and I'll patent this and also launch a product in the market. Now you're spending that 1 lakh. Okay, so that becomes your expense. Okay, that let's say this 1 lakh or 10,000 rupees you gave to as labor, 50,000 to material, and XYZ categories, you spend that 1 lakh. Okay, now you should at least recover that 1 lakh. Only then you make it your break even. Otherwise, it's a loss, right? But there is also an opportunity cost. Okay, that means that if you did not, invest this 1 lakh into this patenting of this idea, or into this IP, right? You could have been, put that 1 lakh in a bank. That's a bare minimum. Okay, let's say you would have got. Let's say you put that 1 lakh in your FD. Okay, in a bank, you will get 7%. Okay, minus inflation, probably the 4-5% is what we are talking about when it comes to FD. Okay, fixed deposit. Okay, so that is your cost that you have lost, right? So that is your opportunity cost. One way to calculate opportunity cost. You can also look at opportunity cost as, let's say you left your job. You're getting some, X lakhs of salaries. Okay, salary. So and you're taking 1 year to develop this and launch in the market. So that amount that you lost, you should have got a salary, right, for that 1 year, but you are after this, that is your opportunity cost. But what happens in the industry by and large, we don't usually look at the opportunity cost when it comes to salaries, because different people have different packages, salaries, because they are in different brackets, and an innovator or an IP creator may not be in the top brass. It could be from any levels, right? So a common thing that we do as an opportunity cost is the bare minimum that you can get is by investing in, or putting that money in your FD. That's the bare minimum. You also can measure against your stock market, the share market. So you look at an average of let's say 3 year, 5 year share market performance, which means that if I did not put that 1 lakh rupees into this, developing this, creating this IP, had I put that into the share market, I would have got at least 15% interest, right? So I'm losing. That is my opportunity I've lost. Okay, so 1 lakh plus that opportunity cost becomes the value of the IP. Simple as that. Is there any doubt about this? Have you understood?
But it differs from person to person.
Sorry?
It differs from person to person. Opportunity cost will differ from
Yeah,
person.
opportunity cost will differ from person to person. So as an industry, what we do, we don't look at from from a person to person. We look at standards. Okay. So if you look at rate of returns, right? Share market is doing well. Sensex is doing well. So that becomes the benchmark for us. Okay. We don't look at from a personal characteristics, because then there'll be no end to it, right? You can claim anything, right? I had to sacrifice this, I had to sacrifice that, my job, my this time, everything. So there is no end to it. So it differs from person to person. So we will not get into that, though it is an opportunity cost, okay, from person to person. But what you could have done, you could do is that if I had invested in the share market, this is the logic that people apply. I would have got so much percentage versus I'm applying to this. So you take opportunity cost as that. Okay. If you have no more doubts on this, then I'll move to the next one. Shall I?
Yes, sir. You can go forward.
Okay. Good. Now let what is the advantage? Okay. So the advantage is, this is very basic common sense, right? It is easily determined based on actual historical cost. You know the cost, you added some percentage to it. That's the cost method. Okay. That's the cost method of IP, your intangible asset or intellectual property. What's the disadvantage? You're actually not getting the correlation between your revenues, right? What if I had actually got much more, right? Am I restricted to the share market? I want much more. So if I had launched a product in the market, I would have got much more sales, right? So this doesn't give any picture of that. And that way, this is probably the least used. Okay. The least used method, probably among the least used methods, this will be the one. But this gives a sort of thing that, I've spent this much money and this much time, give me so much extra. That means I have at least break even. That gives you that's some understanding. Okay. Next is the discounted cash flow, the income method or the income approach. Okay. Again, this is a vast subject area. So, approach, we use the most common method is something called the discounted cash flow. Discounted cash flow, or DCF, it is called. Okay. What are we doing in discounted cash flow method? You forecast cash flow based on future income stream. Okay, for your patented product or solution. Okay, and then you forecast the cash flow, and then you discount it to today's value. Okay, I will explain to you. Let's assume you have an IP worth its value is for next 10 years. There is a value for that. Okay, now you are going to say, I'm going to get revenues from this IP for the next 10 years. Okay, and that will be a forecast. You don't know what is the current value, what you will be getting, but you will do a sort of assumption. You will forecast. Okay, now once you forecast, you will also know, you will discount it to today's rate. Okay, you're saying 10 years, like every year, like I'll get so much, but I will discount it to today's rate. So I know what is the value of that IP in today's rate. Okay, that is called discounted cash flow. I will explain to you with the example also. Then it becomes more clearer. But let's look at the basics of what is DCF, so that when I walk you through that example, you will understand what it is. And I also have one assignment in the end which I've given. We can solve it today, or you can take it as an assignment. Okay. So with that, you will at least know how to do it. You don't need to become an expert in this, but you have some understanding. Okay. In the future, when somebody says, okay, how do you measure value of IP? Let's say you might be a lawyer, you might be litigating a case, and I know this is the damages. I could have got this much money, and that's my value of the IP. So you should be able to say that. Okay. So one of the methods in DCF that we use, it's also discounted cash flow method, is a relief from royalty method. So what we are saying here is that what is the you know uh, value of the royalty that uh, you know uh, uh, a company would pay if it did not own this IP. Okay, so because it's a relief from that royalty. Otherwise, if I had not had this IP, then I have to pay the royalty. Okay, so it's a relief from royalty. So this is something which we will again discuss now. What are the steps involved? Please note these steps. Okay, so the first and foremost, like I said, you need to forecast the revenues. Okay. For the first year, let's say I get 1 lakh rupees. Second year, I will get, 1 lakh and 25,000 rupees. You forecast your revenues. Okay. And there should be some logic to the forecast also. You cannot simply, you can forecast anything, but there should be some logic to it. Okay. And we will see how to arrive at some logic. Once you forecast the revenues, you deduct the costs, usually the patent cost. So this is very specific from the relief from royalty method that we're talking about. You forecast the revenues, you deduct the costs. Okay, so that your income minus your expense becomes your profit, right? What you get in minus what you have spent becomes your profit. So that becomes your profit. Okay, then you actually calculate the calculate the present value. That's called the PV. Okay, PV stands for present value of the expected future income on that patent. So there is a formula for that. So PV equal to FP into 1 by 1 plus R to the power of N. So this formula you should know by heart. Okay. So what it means that the present value is equal to future it's future value. Okay, or future payment, you can say. So future value, future payment into discounted factor, which is nothing but 1 by 1 plus R to the power of N. Now I'll explain to this. And then once you find this PV, you find net present value, okay, which is sum of all the PVs. Okay, now I'll take one by one. So this is the formula I said. Okay, now here in this, there is 2-3 things you should understand. One is the discount rate, that is the R. If you look at the formula, the R, That's a discount rate given. Okay. The other one is N. That's a time period. Okay. And the discount factor. Discount factor is 1 by 1 plus R to the power of N. What this means. Okay. So what is a discount rate? In this case, the value R rate, it is a rate of interest for an investment. Okay. Now you have invested into a project or you have invested into this patent. Okay. You expect some rate of return for this. Okay. That is the R. Okay. So which means higher the risk and uncertainty of the investment, the higher the discount rate. Okay. And lower the present value, because PV is inversely proportional to, it is 1 by R, right? If you look at here, PV is inversely proportional to R. Okay. So this means, let's say you have a high risk project. Okay. Okay. And if there's a, that means your risk rate, the discount rate will be higher. Okay. And your present value will become low. Okay. So higher the risk, lower the value. Lower the risk, higher the present value. Okay. This concept you should understand first and foremost. Okay. Now calculating the discount rate. Now, how do you calculate this R value? Okay. So there is something called weighted average cost of capital. We will not get into the formula. There is again a complex formula to calculate R. Okay. Because how do you know what interest rate I should get, right? People say, again, a benchmark would be your FD. Okay. Your FD, your fixed deposit gets 7% returns. I want to get 10% returns. So that is your rate of interest, right? Your returns that you would like to get are 10%, which means that I'm at least getting more than what I'm getting in the bank. But that's a crude or a thumb rule that people use. Okay. When it comes to investment returns. Okay. But there is a way to do that. There is something called the weighted average cost of capital, which actually takes the equity debt ratio of an organization and arrive at a WACC, back the rate of returns. We'll not get into that. Again, for IP valuation, we again use the weighted average cost of capital, the debt to equity ratio. We also look at the jurisdictional risk involved with an IP. We add that two factors and arrive at a rate of return. Basically, we are saying usually, by and large, if it is an established projects where there is already a standardization, then we know the discount rate. Okay, it could be 12% returns, 13-14% return. I know that if I invest in this construction business, I will get 12% returns. If I'm going to invest, become a trader, I know I'll get 5% returns. If I'm getting into this manufacturing, I know it's 10% returns. So I know there are industry-wise, there are it is standardized. I mean, by and large, it is standardized. But when it comes to IP, there is a higher risk. Okay. So when you have a higher risk, because IP is something you're new. Let's say you're talking about patents. Patent is something new, right? It's a new process or a product that you launched in the market. You really don't know what is your market. So the risk is very high. Okay, which means the present value will be very low, but your revenues will be larger because this is a new product in the market, and so you will have higher revenues, but the risk is also higher. Okay. So that is how the discount rate is calculated. So you should know how to calculate discount rate. You should play around discount rates. So as a if you are into the field of valuation, this is where we actually play around with the rates. Okay. The next aspect, I'm going back to the formula. We're still in this formula. Okay. We're taking some time because this is the core. This is the crux, and once you have understood, there is nothing more to actually tell in this class. So next is the N. This factor, PV is equal to future value into discount factor 1 by 1 plus R to the power of N. N is the time. Okay. What is N? It is in the case of patents. Okay. It is the remaining useful life of a patent. We said patent is valid for 20 years. And I said, 20 years we'll not take. It's 5 to 10 years is what we take. That is N. Number of years. Okay. That is your N. However, we don't actually look at the if let's say if the patent is valued for 10 years, there is still a useful life of 10 years. We'll say, okay, patent life is 10 years. We look at technology obsolescence, which means that like I said, it may not be there for like another 10 years. uh, for example, cryptography, uh, or for example, we used to say cloud. So many technologies, right? We'll say, okay, this has become saturated, so anything that is new in 5 years it will change. Okay. So we sort of understand the technology obsolescence, we understand the actual patent life, we look at the is there any contract to this patent. So among this, the shortest of this lifespan is what we take as the actual useful life, and take this value n in this formula. Okay. So that is the number of years. Okay. Now comes the uh, other part, the discount factor. So this discount factor, which I said in this, the 1 by 1 plus r to the power of n. Now you know discount factor is a function of the time and the interest rate. The time n or t, you can put it as t or n, and the interest rate r. Right? It's a function of these two. Right? So what it essentially means is that this is the factor by which your money will be reduced, okay, to reflect the time value of money. Okay. Now, what is time value of money? I'll give you an example. Uh, Today, if you have 100 rupees, you will get a decent vegetarian meals, right? You will get a decent vegetarian meals. So that is the value of the vegetarian meals, 100 rupees. 5 years down the line, with the same 100 rupees, you will not get that same vegetarian meals. Okay. Why? Because the money has been depreciated, right? Money over a period of time depreciates its value. Okay. So there is that has to be taken into account. Okay. That the time value of, that's called the time value of money. The time value of money needs to be taken into account and discounted when you calculate. And that is what this discount factor, the meaning of the discount factor. And when you have essentially taken the time value of money and discounted into the discount factor, and you calculate your present value of your IP, calculate over a period of time of all the future inflow of the money, that is your present value. For every year, you will do that present value. The net present, after you calculate all this, you will actually calculate the net present value, which is the sum of all the present values. Now, it might be a little confusing. I will take an example. Okay. I have projected a Excel in the display. Can you see this?
Yes, sir.
It is there, right? Yeah.
Yes,
Yeah.
sir.
Right. I'm going to explain to you this. Right. Now, this is an example. Okay. Here is a OLED monitor. Now, let's say we're talking about, let's say, TVs. Okay. So these days TV come like LCD, LED TVs, right? You have OLED TV. So it's called organic LED TVs. Okay. So it's probably the latest, and you have other sort of displays also, but OLED technology was once upon a time, last 10-15 years, it was been there for a lot of research, and a lot of patents are around OLEDs. So assume the cost of an OLED monitor, which is patented. Okay, there is a patent behind this. Now the cost is 35,000 rupees. Okay, this is the cost. Okay, of this monitor. And let's say the company which makes this plans to make around 10,000 units every year. Okay. Now my expected revenue from this is 35,000 multiplied by this 10,000. This is about how much? 35 crores, right? 4, 8, 9. Yeah, 35 crores. Okay. This is the expected revenue from this. Okay. Now there is a royalty rate. Okay. The company expects a royalty rate of 5%. Okay. There is another company which expects 5% royalty rate. So expected revenue from royalty is 5% multiplied by this 35 crores. That is coming up to how much is it? 1.75 crores. Okay. Now there is So these are all inputs, okay? I'm just explaining. These are all inputs. This will be given, okay?
Sir,
Now,
may I
sorry.
ask one question?
Yes, please.
Sir, this royalty is on what? On
So
what interest?
royalty is for the patent behind this, okay? So assume this. There is a company which has a patent on OLED monitor, okay? The company is expecting a royalty of 5%. Usually, the royalties are also standardized across industries. Uh, so let's say the company expects a 5% royalty for their patent. Now they're going to trying to sell this patent to a manufacturer which manufactures the OLED. Now these are the inputs. Okay, the cost for the OLED is around 35,000 in the market. Okay, now the number of monitors that the manufacturer makes is around 10,000. So around this is the expected revenue. Now let's say 35 crores. If that is the expected revenue of that manufacturer, the patent holder which has that OLED patent wants a royalty rate of 5%. Is that clear? Till now it is clear?
Yes, sir, now it is clear.
Yes.
So this
Yeah.
OLED monitor cost is from the manufacturer's point of
From the manufacturer's
and
point of view. Yeah.
and the technology is with some other person.
Technology is with somebody
OLED.
else. OLED.
Okay.
Okay. So you actually, so this is the money that 5% of that total value is 1.75 crores. Okay. Now we are looking at a discount rate of 10%. This is an assumption that we are going to do. We saw in our slides the discount rate, the value R, right? So that is 10%. Okay. Uh, let's assume this patent is going to be valid for 5 years. That's the useful life of that patent. That's for 5 years. N is equal to 5. Okay. In that formula, 1 by 1 plus R to the power of N, right? So R is now 10%, N is 5. Number of years this patent life is 5. Okay. Now, how do we calculate this net present value? So the patent cost, let's say this patent for this person to get the patent, it was 3 lakh rupees. Okay. He or she had to spend 3 lakh rupees. Okay. Now assume that the cost of monitor development is around 70,000. Okay. So let's say 73,000. Had this person done this monitor development, it is 70,000 rupees. This is just an assumption again. Okay. So let's say this person should have spent 73 lakh rupees, which is like a out of pocket expenditure. Okay. In this case, the growth rate is fixed at 20%, which means the industry grows by 20%. This particular OLED monitor industry grows by 20%. Okay. So how are the revenues being calculated? So revenue here, I'm on column number D14. Okay, D14, that where it is written, it's how much? Yeah, 2.1 crores, right? So basically, what is the revenue? So this expected royalty, okay, for the first year, okay, C5, here it is C5, multiplied by the growth rate. This is the growth rate, okay. This is my projection for the first year of royalty revenue, okay. Now I calculate this so this is compounding, okay. The year 2 will be year 1 into 20% royalty, 20% growth rate, okay. Year 3 is again year 2, year E14 into 1 plus C to the power of 13. This is the year 3 revenue projections from royalty. Year 4, year 5, you calculate similarly, okay. Let's say there is a maintenance cost of this patent around 20,000 per annum for 5 years. I'm taking that. Okay. What is my cash flow? My cash flow already has, let's assume there is a minus 73 lakh here. But here, if you take this revenue minus your expense, that is your, current cash flow. This much you have cash. Okay. This much you're projecting your cash. Okay. You're projecting your cash flow. Now, once I project my cash flow, so this becomes in the formula, if you remember, PV is equal to the future value into the 1 by 1 plus R to power of N, right? That future value. So this 2098, that is the future value of that That's the future value of the cash flow. Okay. I have to multiply that by the discount rate or the discount factor, right? The discount factor is, the formula is, if you see here, 1 by 1 plus C6 to the power of 0. Okay, C6 is what discount rate is. This is your N, right? Sorry, this is your R. Okay, so R to the power of N. So N is 0 in the first case. For every year, you change the time by increment by 1 year. If it's the first year, 1, this becomes 1. If the second year, this becomes 2. Third year, it becomes 3, and so on and so forth. So this is the time value of money. This is a discount factor you're applying on your future cash flow. Okay. Now you multiply this D16 by D17. Okay. That gives you your present value for that particular year. For year 1, you will get this as the present value of the cash flow. So same way for year 2, you will multiply by E16 by E17. So that becomes the present value. So you're multiplying the cash flow by the discount factor. You will get the present value for year 2. Likewise for year 3 and year 4 and year 5. Okay. Once you got this, like I said, the net present value. So the net present value is the sum of all of this. How much cash you have would have expended, and how much cash this would have, you would have got in 5 years. That is the sum of all of them. So this is around how much? This is around 10 crores is the actual value. Okay. This is the value, net present value of the patent. Okay. From this 10 crores, you can actually negotiate with the manufacturer saying that give me 1 crore, okay, as an upfront fee, and remaining on as royalties on so and so so much money on yearly, this much money. This is how the net present value is calculated for a patent using the discounted cash flow. I will pause at this moment. You can ask questions.
Sir, actually, I'm not getting
Do you
this
want me to
formula
explain
thing.
once again?
I'm not getting this formula thing, but anyway, sir, for the lawyer, is it required all these things? This valuation part, the formulas and all.
So like I said, no, what we are looking at, you have learned from a legal aspect what is IP, right? So from a lawyer's perspective, by and large, you only have to look at the legal aspects of IP and the management of IP. But when it comes to damages, calculating damages, that is one area from a lawyer's perspective. If you're a practicing lawyer and you're representing in the courts, when it comes to damages, you should know how much to ask for. Let's say you won the case, right? Or you want to put a value, for the infringement, right? In that scenario, as a lawyer, as a practicing lawyer in the courts, you will need to know to calculate the IP with respect to damages. But usually,
These are, sir, but very special formulas, not general formulas. I think are there some other specific valuers for the particularly for the IP, or a registered valuer defined in companies that can also do it?
Come again.
Do we have any sector specific? Do we have, sir, any sector IP specific valuers who do this kind of job?
Oh yeah. So in India, if you're looking at in India,
yes, India.
The chartered accountants there are accredited chartered accountants. There are not all CAs. There are certain CAs which are are deemed as valuators. Okay, they are the ones who can actually value and then give a seal. But
who, sir?
Let's assume CAs, chartered accountants. Okay. There are CAs who do valuation. They can do that, but that is from business valuation perspective. In India, there are law firms which actually does this valuation, IP valuation. Okay, there are few law firms which does IP valuation, and usually when it comes to a court matter, and there is a damages that needs to be calculated, the courts will the representing the lawyer would actually seek the help of a chartered accountant, and in turn the CA will take the help of a IP valuator, and then arrive at the cost.
This
Even
IP valuator, is it recognized by law, something like that, or just we, is it, it's a
no,
terminology used?
no. IP valuation is recognized in the US. For example, I'm a certified patent valuator, but under US. But in India, we don't have. Only CAs can do it. I am not a CA. Only CAs can just sort of put the seal on that valuation. But the valuation will be calculated by IP evaluators, which are like, there are law firms which will have that. To answer your question, there is no specific person called IP evaluator, but there are people who do IP evaluation. For example, KPMG, right? Usually if in the, let's say there is a matter which is for damages that needs to be calculated, they will approach one of these big four auditing agencies where they will have IP evaluators.
Got it, sir.
Okay.
Have you any idea, sir, whether there are law firms also who do this kind of job?
Yeah, in fact, I do. So in our law firm, we do this. Yeah.
You are in Lex Orbis, sir.
Yeah.
Okay, sir.
So we have a team. So we are a team of 3. One of my colleagues actually, I think she took a session. Dr. Shivani took a session earlier. She's in my team from Bangalore, but we have somebody in Delhi who's from KPMG. She's also ex-KPMG. She's been doing valuation the last 10-15 years in KPMG.
I think I'm in touch with some person in this firm only, Lex Orbis only.
Probably. So it will be any out of these 3, we are the people who do valuations.
By any chance, sir, may I get your contact details?
Yeah, that's fine. Yeah. You could write to, it has to go to Delhi, and then our HQ is in Delhi, though I am from Bangalore office, and they will take it up from there. But yeah.
Thank
so
you,
coming back to your question, yeah. So why lawyers would need? This is one instance. So even you may not be doing it, but
what I've understood, sir, that IP valuation will be done by the sector-specific firms, and it will get sealed by the CA.
Yeah, exactly. You're right. Okay. So that's the instance where this has to be done. Now, coming back to this case, do you want me to explain once again, or is this okay? Or we will do one thing. We will continue the session, and I will take up that assignment, and then you can do it on your own. Okay. And then if you have any doubt, it is again, just have to fill according to this same sheet, and then you will understand what it takes to value an IP. Okay. So let me just go back to our presentation. Yeah. So we saw now income method, one example of income method. The whole idea is to know what is the discount rate, what is the time span for the value, and calculate your discount factor, which is 1 by 1 plus R to the power of n. And then you arrive at the present value of the cash flow, future cash flow, and you discount it. Okay. And finally, you add all the values, the present values, to arrive at the net present value. That's called the net NPV, or the net present value, okay, of a future cash flows. This is the this is the most commonly used approach for valuation. Even if you are going to a chartered accountant for a business valuation, usually they do a business valuation. Let's say there's a merger and acquisition, somebody has to value the company, right? Let's say this company is $1 billion. How do you value the company? You use discounted cash flow approach. Okay. So this is the most commonly used and most understood by the people in the industry, be it chartered accountants or from a litigation perspective. This is the most commonly used. Okay? Now, what's the disadvantage? Here, the cash flows that we're talking about is very subjective in nature. They may not be the actual value. Okay. Most of the time for business valuations, you will have there will be past precedence, which means that, the business would have ran their business for 3 years. They know what is their future, cash revenues. But when it comes to IP valuation or patent valuation, you really don't know. Probably there is no revenue at all, but you are sort of, contemplating that this is something which I can get. Okay. So it is a very subjective in nature. Okay. The other aspect is that this does not take into account anywhere the market volatility, right? The markets are volatile. Okay. There is a war in Ukraine. How does it affect you? There is a supply. Let's say there is a. This is one of the oil companies of India, right? You don't know where the oil is going to come, right? There's a shortage of supply of oil, right? Right? And I'm in the business of that. Now, what do? I don't take into those factors into account. So basically, we are not taking in discounted cash flow. You don't take into account any of the market factors, anything volatile, the instability of a particular regime. You don't take into any of those consideration. There are other, sorry. So there are ways to there are other valuation methods. So there is something called the Monte Carlo method or the Black-Scholes method, where we actually take this. You got this net present value, right? We take this net present value, and there's a formula for applying these external factors and see how sensitive your net present value, which means the net present value. Let's say there is an implication of a shortage of fuel. Okay, so then how the net present value varies with respect to that. There's a war in, let's say, Israel. Okay, now how does it apply to this net present value? So there are ways to do that. So we use something called the Monte Carlo and Black-Scholes, which is beyond the scope of this particular discussion, so I will not take it up. But just know that the most common method used for valuation is the income method or the discounted cash flow, which is DCF is one of the income methods, the discounted cash flow, DCF method. The DCF method basically takes what the future cash flow discounted by a rate, giving the discount factor to consider the time value of money and discount it at the current rate or the present value, and then you calculate the value of the patent or the IP. Okay, that much you know. The third method. So I said in my initial slide there are three in the classical methods. We saw the cost method, we saw the income method. The last one is the market method. What is market method? Is very simple. You look at the past transactions in the market, okay, and see, okay, let's say this company bought this patent for so much money, okay. So that becomes your market precedence, okay. So you cannot go. So there is a sort of fair market value there already for a patent existing, okay. Then you can't claim. Then you don't have to go for a DCF method or anything, because okay, there is a market precedence, so this is my value. Advantage is that it gives a fair idea of market value. The disadvantage is that there is the limited data on these transactions in India, especially in India. Where the data is not so readily available, and there is vastly much of transactions which are in the IP space. So data is very less. But again, when we look at the Western markets, they do have databases where you actually can see what is a past transaction data and know what is a market value. That sums up the three methods. I'll quickly. So I said, now coming back to the patent licensing part. So we saw first one was the due diligence. We saw that we will do a technology evaluation. Third, we will do a patent valuation. Fourth is the licensing part. How we do. So we represent the client. We'll be on the buy side or the sell side. So we are like brokers basically. Yeah, you have real estate agents, right? Who actually do a brokering of the apartment or a land. Same way, we actually sell, buy or sell IP. Okay, so we do all this. So we identify potential licenses. We have industry networks. We have something called LES networks, Licensing Executive Society network. We know the people in the industry. We know the IP people in the various companies in India and abroad. So we talk to them. We identify, do you have any requirement for this? We have this portfolio of IP. Can you, do you think there is a market fit for you guys in your product portfolio? So we discuss all that. Then we sort of create few documents, the non-disclosure agreement. There's a teaser PowerPoint. Then there's something called information memorandum and a financial modeling. Financial modeling is where you saw the valuation of the IP, right? So that is a very, very simple form. We have much more complex models that we actually generate. And with that, we sort of know that this is the IP, value of IP, and then we try to negotiate. Once we negotiate the deal and then the contract is signed, the next most thing is that you sign the contract agreement. Okay, they're drafting a contract agreement. So some of the things are in the licensing agreement is that you who owns the patent rights. Like I said, this is very important when you draft a patent licensing contract. Then you have the jurisdictions. Okay, which are the jurisdictions? What is the cost sharing? Who's going to share the cost? Right? Just a moment. Just hold on. I'll just yeah. So I was coming back. I was talking about the licensing agreement. Once you are done with this, these are factors that you should consider. The ownership, the jurisdictions, the cost sharing, the assignment clause. This is very important. Okay. Then you have the enforcement clause. Okay. In the case of enforcement, which are jurisdictions covered, who will bear the cost and things like that, who can enforce whom, and so on and so forth. And the IP demarcation. So there's a clear demarcation of IP. So you will have a portfolio. So in the portfolio, you have probably saying that, okay, this is the IP that I would like to sell or license, but this other IPs are not involved in this particular transaction. So you have to clearly demarcate. So just know that the licensing agreement has to be a watertight agreement, so that there is no room for any faults there. Okay. Just know that how IP is treated in the financial statement. This is also important. The income from IP. Let's say you're exploiting your IP, and then the income from IP. Okay. So any income from IP. So you have to know when it comes to financial statements in an organization, you have the income statement, which is the profit and loss statement. You have the balance sheet. Okay. You should be able to read these statements. Okay, then you will understand. So any income from IP will go to the income statement or the revenues. Okay, so that is the income. Okay, then if you are trying to create some IP, it goes as an expense. Okay, there is an expense. Okay, that goes into the expense statement. Okay, so the income and the expense go into the profit and loss statement. And if you buy an IP, it becomes an asset and becomes a part of the balance sheet. Okay. So when you talk about IP as an asset, okay, it is good to say it's an intangible asset, right? We talk very, very broadly, very loosely, saying that, okay, this is an asset, this is an intangible asset. But if it does not get into the book of accounts, which means your company's financial statements, right? If it's not there in your balance sheet, or if it's not there in your income statement or a profit and loss statement, if it's not reflecting in this, really you are not actually considering that as an asset, because asset is something which has got value, right? And if you need to value, it has to get into your financial statements. Somewhere it has to reflect, right? So only then it becomes an asset. So IP is treated as an asset if it goes into the balance sheet, and it is treated as an expense when it goes to the profit and loss statement. Please note these 2 points when it comes to IP as an intangible asset. Okay. We use very broadly as practitioners, we use very broadly, this is an intangible asset. But when you look at the real intrinsic meaning of the value of that asset, it has to get into the financial statements. It has to be reflected in the financial statements. Okay. With that, I will stop. We have this valuation exercise. Do you guys have an Excel sheet with you by any chance? Would you want to try doing this? Or you can take this as a assignment, and you can get back to me if you don't have it right now. So I will stop this for a moment and to take questions.
Yes, I think, Mr. Jacob, this can be sent out as an assignment, and they can take some time and work on this.
Sure.
And since the PPTs also would be shared, they can just go back to the formula and then
Sure.
see how application happens.
Sure.
And
Yeah.
keeping the screenshot that you had shared
Yeah.
of the problem solved. So that is something that they can work on.
Sure. So I've sent all those details, the PPT, this valuation exercise questionnaire, and there is a solution to this also. So they can just go through it, and if they're not able to find work on it, then they can actually refer to it. And still, if they are not able to do it, then they can ask me at any point in time.
Sure, sure. I would request the participants to please try this out. And for those of you who have not who have not been in connect with Dr. Anchal, I will also share her email address with you. So you can just reach out to her to get these PPTs and the assignments as well. Yeah. So any questions?
Or was it?
I have one
Yeah.
question related to this IP, sir.
Yeah.
Sir, in our India, there are no such stringent laws, sir. First of all thing. Regarding with the IP, what is the scope, sir? One thing, sir. What is the scope? And regarding with this IP, sir, it's a time taking area, sir, to get licenses, all these things. If we get the patent in India, if you go for the other nations, in India, it is very time taking management, where in other countries it is easy. When I attended the EBC, not they conducted the one seminar in what in Nalsar University, they said that it is very easy to get the patent in other nations, but in India it is very hard. It takes a 3 years, 2 years. Now it has been very reduced also time, 30 days. So there is a little bit confusion, sir, for everyone. So regarding
Okay. Yeah. So I'll answer your second question first.
Sir, my question is this: to the newcomers, sir, to the newcomers, being an assistant professor, sir, I'm working in a Mahatma Gandhi Law College. I regularly refer this ABC learning book, the ABC books to my students in my classroom teaching to build what the subject oriented skills. First of all, thanks, madam, for admitting me in this session. And to state these things in my classroom teaching, sir, regarding with this IP, please give some suggestions, sir.
If I may understand your question correctly, one, who will use this IP? Who may use this?
IP will be used, the person who gets the patents, it's okay, sir. The scope, sir.
So the scope of IP, okay. As a career, or as a
career, sir, to the student, to the students.
So in India, if you look at the IP, the last 20 years or 25 years, we have evolved significantly from a career perspective as well. So earlier days, like you said, there are earlier days litigation cases were very less. I think till around 15, 20 years back, we only had some 50 cases or so. But last 20 years, we have seen multiple IP litigation cases in the various courts, especially the Delhi High Court and Supreme Court. So we have seen there is a sudden jump in the number of IP litigation matters. That is the last 15, 20 years story. If you look at from a career perspective, people used to be there was if you have to get into this field, either you can become an attorney and a lawyer. Early days, lawyers were actually given by default. They could actually apply for their agent certification. They would have got. But now, anybody who's in the science stream or in the engineering stream are eligible for this, and they can actually write agent exam, and then they can clear this agent exam. Once they clear the agent exam, they will become they can typically get into a law firm or IP. IP firms are there. Several IP firms are there. Several law firms are there. IP law firms are there. And they can start as an associate. Then you have a typical structure in a law firm: associate, senior associate, then managing associate, associate partner, and partner. So this is a typical law firm structure, and they can actually pursue their career in IP in a law firm. A lot of multinational corporations who have got their R&D centers in India, they engage in-house IP councils. So there will be an IP team within all of these MNCs. So you talk about large multinational corporations, talk about Google, talk about Motorola, talk about Qualcomm. These are all the multinational corporations that we see here around Microsoft. So all of them have a in-house IP team. They have members in India as well. So and then, of course, the Indian companies also have the TCS, the Wipro, the Infosys. They all have fairly large IP teams. Honeywell is a large IP team based in Bangalore. So So if you look at from a career perspective, the last 20 years we have seen a great boom in the careers prospect, both from a law firm perspective and from an in-house counsel perspective in these big organizations. So that's the usual career path for somebody who's in the field of patents. That is number one. Number two, of course, if you want to practice, you can become an attorney, and then you can practice litigate matters in the various courts. Right now, Delhi has a separate division for IP matters, and Madras High Court also has a separate division which can take into IP matters. So that's the typical career path. I think that answers your first question. So it's a good field to be in. Now, of late, a lot of people are opting for this career. We have so yeah, that answers your first question. Second question on the timeline. So again, you have to see from a I'm again talking about 20-25 years back. Yes, you are right in one way saying that we used to be a country where the time period for getting a patent granted was quite large. In fact, not even 3 years. When I began my career, it was 8 years. So even if you look at the lifespan as 20 years, it used to take about 8 years. And in 2008, 7, 8, there was great changes being brought into the patent office, the intellectual property office of India, the patent office. We have 4 offices in India, on 4 metros. So there is a lot of change happened in the year 2007, 8, 9. It saw so then. And then slowly, as a country, we moved to digitization, and so is our offices, not just patent office, even several of our other government offices, and even the patent office. We saw we have done extremely well. We have brought in a lot of systemic changes within these offices, and we saw a lot of change. And now to say that it doesn't take 8 years anymore. Now it takes, like you said, 3 years is something which is a reasonable time. 3 to 5 years is a reasonable time. And if you are a startup registered under Startup India program, there is something called the Government of India has a Startup India program. There has been instances where the patent has been granted even less than a year. So we have set precedents in that aspect also. We have actually given grant for patents within less than a year. Now, comparing to the US markets, the other Western countries, yes, they have much more systemic efficiency in terms of the number of resources available. The US PTO is around 10,000 or 12,000 people, versus we are in thousands. Earlier, it was very less. We were only 300 people or something. But now it's quite large now. So that is one way we are increasing the number of workforce. And so is the backlog. The time, why is the time taken 3 to 5 years, is because we didn't have adequate manpower. We are trying to bridge that manpower. And now we have recruiting a lot of examiners in the patent office. So the timeline has been short. Having said that, US also takes about 2 to 3 years. It's that is the norm. And that is by law, if you look at the legal aspects of a patent, sir, if you file for a patent, it takes about 18 months time to get it published. So that itself is take about 1.5 years is gone there. That is that is what jurisprudence is, right? So it is a time-consuming process, and across the world, it's a time-consuming process. In the US, it's 2 to 3 years. In India, it's about 3+ years. I think I would have answered the second question. Is there anything else, sir, on that?
Thank you, sir. Actually, I have one student who is working as an HR in IP-based company, but he didn't clear the message related to my question. When I put the question, the same related question to him, recently he joined. He said that the IP sector is a very good sector, sir. It's doing their company is doing very well, but I don't know how they generate the income, all those things. So little bit he confused me in getting the answer, sir. They cleared out. No, thank you, sir.
Okay. Yeah. So rest assured, I think it's a very promising field. Yeah, and we have many in-house roles opening up. If you look at companies like GE, Honeywell, they all have a lot of in-house roles. As in-house counsels, you can join them. So yeah.
To be frank, sir, I am a practicing advocate. I have each and every knowledge related to the court proceedings regarding IPC, CRPC,
Yes, sir.
everything that MUOP acts or a family OPs or enacts, anything. But regarding with this IP, intellectual property, I was a little bit confused. Recently, last week, I joined this session also. I was dilemma. I was in dilemma. What the session is going, what they are saying. So I was new. I was new. I studied IPR just in an examination point of view. Written exam, passed exam, ho gaya khatam. So
Yeah.
I want to know. This Nagaraj has made me to attend that session, sir. So he has given an opportunity also to know that. So to means whenever, sir, we are in a teaching field, to place the students in a better field. So I would this session has made me helpful to what get the doubts cleared. Thank you so much, sir.
So just to add one point, so like I said, the earlier days, I mean, the 20, 30 years back, we did not have much of litigation matters also. If you, because you're a practicing lawyer, there were not much cases around. I think somebody has done a research, they have analyzed for like 50 years from independence, and there were only 50 cases or something. That's all the IP matters were handled in the court. So that was the past, but now there are plenty of matters. That is even from a practice perspective, there are many cases of IP in the courts.
Thank you, sir. Thank you.
So
Thank
any
you.
questions pertaining to today's this particular session on IP valuation? Anyone? I don't think that would be a better way than Mr. Jacob simplifying this whole subject, this really complicated subject of IP valuation.
Nobody
Really, I
touches the
think
subject. Usually
yeah.
people go for drafting, or either on the litigation side, or they go for drafting patent applications or IP.
I think
But
this
valuation is something very
perspective that we saw
Yeah.
today of the subject
Yeah.
of IP, and
Yeah.
nothing better than the way you have demystified this whole complex subject of
Yeah.
valuation.
Sir, one question I have.
Yes.
Yes,
Sir, is that trademark valuation, is it also done?
Yeah. So,
And according to me,
largely-
what knowledge I have or acumen I have regarding IP, I think in that case, the sales figure, market research reports, that will be a factor for trademark valuation.
No, a trademark we look at from another perspective. We look at from a relief from royalty perspective. See, there is no sales, right, of a particular product or a process. But we look at the, let's say,
No,
let's
sales
assume,
of the products bearing that mark.
bearing that mark. That is how it is. Yeah.
That is what I'm asking.
Yeah.
So that certificates, suppose for past 15 to 20 years, someone has not got its IP evaluated, but its IP has got goodwill and reputation in the market.
Yeah.
So those certificates, those sales figures and marketing expenses, will they be having impact on the evaluation?
Yeah.
Would
If
they be the
product-
only factors, or there are some other factors also? That is my question. This is what I understand.
So trademark falls under the, for example, let me give a classic example of, again, Kingfisher. Okay. So it's a brand. It didn't. So Kingfisher is a brand. So there's a brand value to it. There was a goodwill. I mean, the goodwill is perspective as of now. So the value is on the, like you said, there is a product and which goes out in the market in the trademark state.
Yes.
So that gets added to it. Yeah.
Yes. So apart from the sales and expenses figure, what are there other factors which will be helpful in valuation of that trademark? That is, I'm asking. So this is also my thinking, that sales figure and marketing expenses are relevant. Apart from this, anything else?
Apart from that, for trademarks, there is not much. We do due diligence on trademarks and look at
customer reviews. If we have customer reviews and testimonials saying that the product
those
is
things,
fine.
those are some aspects which we consider into the look at from a goodwill point of view, and does it have any negative impact on the brand, right? So trademarks will fall under a brand valuation perspective also. So we are actually moving from a IP perspective to a brand valuation perspective. So we look at the reviews part of it, if there is any negative impact on it, and so and so forth. But to arrive at a value, yes, these are numbers which you can assign to a product, and then you can get the values, or you can actually look into the sales figures of that company.
Yes,
Usually,
yes.
we look at the
That is
sales
what
figures
I'm
of the company. We don't
That's
look
what
at
my
from a
thinking is. I have never done it, but
product
it's my
perspective.
thinking is that on the basis of sales, we can
Yeah,
identify the value.
yeah. So we assign the value there.
Okay, I think that's pretty much it.
Okay.
So
All right
thank
then.
you,
So
sir.
yeah,
Thank you. And
thank you so much. Thank you, everybody. If you have any questions, you
we
can
will
write
forward the
to
assignments as well to everyone.
Yeah.
Thank you, sir.
All right then. Thank
Thank
you.
you.
All the best. Yeah. Yeah. Bye.
Have a nice evening. Thank you. Bye.
Okay, sir.
Thank you
Bye.
so much for giving me opportunity to join this session.
Thank you, sir.